Let me ask you something. If I told you that the single greatest secret to investment success had nothing to do with genius, luck, or timing, would you believe me? Most people wouldn't. They want the excitement, the prediction, the illusion of control. But investing isn't won by those who guess right. It's won by those who behave right. The truth is, the market doesn't care how clever you are. It rewards only one thing: patience. And that's why most investors fail. They don't lose to the market, they lose to themselves. Every boom, every crash, every headline screaming, "This time is different." It's all the same story repeated through time. Fear and greed fighting for control of your emotions. But if you can master your own mind, if you can sit still while others panic and stay calm while others chase, you've already won half the battle. Because investing at its core is not about predicting the next move. It's about surviving every move and letting time do its work. So before you look at charts, before you listen to forecasts, take a long look in the mirror. That person, not the market, will decide your success. If there's one truth that separates investors who succeed from those who forever chase success, it's this: wealth is not built in the rush of days, but in the quiet patience of years. The market is not a lottery ticket. It is a mechanism for transferring money from the impatient to the patient. The essence of a winning strategy lies in thinking long-term, understanding that time, not timing, is the real driver of wealth. Every generation of investors learns, often painfully, that trying to outguess the market is a fool's errand. The headlines change, the experts rotate, the charts look different, but the lesson never does. Markets move in cycles. Prices fluctuate, moods swing, trends rise and fall. Those who jump in and out trying to capture the perfect moment almost always find themselves missing both the best and the worst days. And in the end, that's what ruins the compounding. The idea of timing the market tempts the ego. It whispers that you can be smarter than the crowd, quicker than the average investor, more alert than the rest. But history and math agree, time in the market beats time out of it every single time. The real game isn't about prediction. It's about participation. It's about staying invested through thick and thin, through optimism and despair, through bull markets that make you feel like a genius and bear markets that make you feel like a fool. Because over the long stretch of time, the productive engine of business keeps turning. Companies continue to innovate, produce, employ, and earn. The market, in essence, mirrors the growth of enterprise itself. That's what you're investing in, not the temporary emotions of the crowd, but the enduring capacity of human progress. When you focus on the long term, you liberate yourself from the prison of noise. The daily ups and downs stop mattering. You stop checking your portfolio every morning. You stop reading every analyst's prediction. You begin to understand that volatility is not risk, it's just the sound of progress happening. The longer your horizon, the smaller the bumps appear. What looks like chaos in a single month becomes a mere wiggle in a 10-year chart. This philosophy is simple, but not easy. It takes discipline to hold when the world is screaming sell. It takes humility to accept that you can't predict the next move. It takes faith in the future, in businesses and productivity, in the resilience of the system. But that's exactly why those who endure are rewarded, because while others jump ship at the first sign of storm, the long-term investor adjusts the sails and stays the course. Let's remember something fundamental. Compounding only works if you give it time. A 7% annual return doubles your money roughly every 10 years, but you don't get that benefit if you constantly pull your capital in and out, reacting to headlines or fearing the next crash. Interrupting compounding is like pulling a plant out of the soil every few months to check if it's growing. It destroys the very growth you seek. Patience, not prediction, is what allows your wealth to bloom. Thinking long-term also builds character. It forces you to define your goals, to clarify what really matters. Are you investing to get rich quick or to build sustainable wealth? Are you chasing the next big thing or accumulating ownership in productive enterprise? The former is speculation, the latter is investing. The difference lies in your horizon. There will always be moments when the market tests your resolve. Recessions, corrections, panics, bubbles. But the investor who sees beyond the moment understands that history is full of recoveries stronger than the declines that preceded them. The long-term investor doesn't ask, what will the market do this week? But rather, what will my investment be worth in 20 years? That question changes everything. It replaces anxiety with patience and noise with perspective. So think long-term. Let time work its quiet magic. Ignore the short-term chatter and focus on what never changes. Businesses grow, dividends reinvest, and compounding turns patience into prosperity. The market rewards endurance, not excitement, because in the end, the surest way to win is simply to stay in the game. In the world of investing, there's a quiet thief most people never see. It doesn't arrive with headlines or market crashes. It works silently, invisibly, every single day, and over time, it robs you of a fortune. That thief is cost every percentage point you pay in fees, every hidden expense, every bit of tax inefficiency is a cut taken from your return. You might not notice it in a single year, but stretch that over decades, and the loss becomes staggering. The truth is, the difference between a 7% return and a 5% return doesn't sound like much until you let time do its compounding. Over 40 years, a one-time investment of $10,000 at 7% becomes almost $50,000. At 5%, it's barely $70,000. The math is ruthless. Costs don't just reduce returns once, they compound against you. It's not just what you earn, but what you keep that builds wealth. Many investors get caught up chasing the next hot fund, the next star manager, the next great idea, all while paying layers of fees that quietly eat into their growth. You pay management fees, trading costs, loads, taxes on capital gains from excessive turnover. All of it adds up. And what do you get in exchange? Most often performance that still trails the broad market average. The numbers show that the majority of high-cost funds underperform after fees. So why pay for promises when the results rarely match? Keeping costs low isn't about being cheap. It's about being wise. It's about understanding that markets give what they give, and the only part you can control is what you pay to participate. You can't predict where the market will go. You can't control how the economy will behave, but you can absolutely control how much of your return gets eaten by fees and taxes. That's real power, and most investors give it away. It's easy to be drawn toward complexity. It makes us feel sophisticated, like we're doing something clever. But investing at its core is a simple business. Own a broad piece of the market, keep your costs minimal, and let compounding do the rest. Complexity often benefits those who sell investments, not those who buy them. Simplicity benefits you. When you choose a low-cost investment vehicle, one with minimal management fees, low turnover, and broad diversification, you're not just saving pennies. You're building a foundation that lets compounding work fully in your favor. You're ensuring that the growth of your capital serves you, not the intermediaries standing between you and the market. Think of every dollar in fees as a soldier taken off the battlefield. The fewer soldiers you lose, the stronger your army grows. Over decades, that army becomes the difference between comfort and struggle, between independence and dependence. So be ruthless about costs. They are small doors through which great fortunes escape. Protect your return, defend your compounding, and remember, in investing, what you don't pay is often what makes you win. When most investors begin their journey, they dream of finding the next great stock, the one company that will skyrocket and make them rich. It's a tempting fantasy. The idea of discovering the next Apple, Amazon, or Tesla feels exciting, almost heroic. But the truth is, for every winner like that, there are hundreds of losers that quietly fade into history. Trying to pick the right one is not a strategy, it's a gamble. The wiser approach, the truly winning strategy, is broad diversification. Own the market, not a handful of hopefuls. Buy the haystack, not the needle. The beauty of diversification is that it removes the need for luck. When you own the entire market, you own the winners before anyone knows they're winners. You also own the losers, but they don't matter as much because the market in aggregate keeps moving forward. Companies rise and fall, but enterprise as a whole endures. Over time, the creativity, productivity, and innovation of business push profits and values higher. By holding the market itself, you ensure you participate in that inevitable progress. Most investors underestimate how difficult it is to identify winning stocks in advance. The information is already in the price, the competition is relentless, and emotions cloud judgment. Even professionals with advanced models and decades of experience fail to consistently outperform a simple broad market portfolio. Studies have shown that over 80% of active managers underperform their benchmarks after costs. That's not because they're not intelligent. It's because markets are efficient and the odds are stacked against trying to beat them. Diversification also protects you from your own biases. When you fall in love with a stock, you stop thinking objectively. You justify holding it even when it falls, you chase others when they rise, and you end up moving money in all the wrong directions. But when you own the whole market through a broad fund, your emotions don't control the outcome. You no longer have to guess who will win. You've already bet on the entire race. There's another quiet advantage to owning the market: simplicity. It frees you from the exhausting game of prediction. You don't need to monitor earnings reports, time interest rate changes, or follow daily news. You invest, you hold, and you let the system of capitalism work for you. It's a peaceful way to build wealth, rooted not in speculation, but in ownership. Diversification is not just about reducing risk, it's about accepting reality. You can't know the future, but you can own it. When one sector declines, another rises. When one company falters, another innovates. The market constantly renews itself. By being broadly invested, you harness that renewal automatically without having to make a single prediction. So forget the search for the magic stock. The needle dazzles, but it cuts your hand when you reach for it. The haystack, on the other hand, contains all the value you need. Buy the market, hold it for the long term, and let time and enterprise do their work. In the end, the investor who owns the haystack sleeps better, grows richer, and wins without ever needing to guess. The hardest part of investing has never been finding information. It's learning to ignore most of it. Every day, investors are bombarded with predictions, market forecasts, economic warnings, and promises of easy riches. Turn on the news, open your phone, scroll through social media. Everyone has an opinion about where the market will go next. The temptation is powerful. It makes you feel like you must do something: sell before it drops, buy before it rises, switch funds, chase the trend. But the truth is, the best investors rarely act on impulse. They build a plan, stick to it, and let simplicity guide them. Discipline and simplicity are two sides of the same coin. Simplicity gives you clarity. It keeps your strategy clean, understandable, and free from unnecessary complications. Discipline keeps you faithful to that simplicity when emotion tries to pull you away. Without discipline, even the best plan fails. Without simplicity, even strong discipline is wasted on confusion. Together, they form the foundation of every enduring investment success. The problem is, most people think investing should be exciting. They believe they have to trade often, stay on top of every twist, and constantly adjust their portfolio. But investing isn't supposed to thrill you. It's supposed to reward you. The more you tinker, the more you trade, the more you react to short-term noise, the more you invite mistakes. Every unnecessary move costs you money in fees, in taxes, and most of all, in missed compounding. The market doesn't demand brilliance. It demands patience. Speculation, on the other hand, is the enemy of wealth. It's a seductive idea that you can outsmart the crowd, that you know something others don't. But speculation feeds on emotion, greed in bull markets, fear in bear markets. It tricks you into buying high and selling low. It promises control, yet delivers chaos. Every bubble in history was built on speculation. Every crash exposed it. A disciplined investor understands that chasing trends isn't a strategy, it's a surrender to emotion. Simplicity gives you freedom from that chaos. You don't need 10 funds or complex derivatives or the latest financial innovation. You don't need to predict which sector will shine next year or what the Federal Reserve will do next month. You need a plan you can explain to a child. Save regularly, invest broadly, keep costs low, and stay invested. That's it. The rest is noise. When the market rises, your discipline will be tested by greed. You'll want to pour in more, chase higher returns, and believe you can't lose. When the market falls, your discipline will be tested by fear. You'll want to sell to protect yourself, to escape the pain of watching red numbers. Both moments are dangerous. The wise investor does neither. He understands that markets move in cycles, and emotion is the worst advisor. Keeps his head while others lose theirs. Discipline also means trusting the process, even when it feels uncomfortable. There will be years when your portfolio seems stagnant, when others around you brag about quick profits, when headlines scream that the world has changed. It's in those moments that true investors prove themselves. Sticking to your plan when it's hardest is what separates those who succeed from those who surrender. Remember, wealth isn't built by reacting, it's built by enduring. Every great return is the result of holding on through times when others couldn't. The simple strategy, saving consistently, investing broadly, and doing almost nothing else, outperforms the complex schemes designed to impress, but not to last. So resist the noise. Resist the urge to speculate, stay loyal to your plan, because in the end, simplicity isn't a weakness, it's strength in its purest form. Discipline isn't about standing still, it's about standing firm. The market will always try to shake you, tempt you, scare you. But if you hold your ground, ignore the clamor, and let time work, you'll find that the quietest strategy often makes the loudest success. When it comes to investing, numbers matter, but not nearly as much as your mindset. The way you think, the way you react, and the way you behave under pressure will decide your success far more than any forecast, chart, or market prediction. It's easy to imagine that investing is a game of intelligence, where the smartest analysts and most sophisticated models win, but history has shown again and again that temperament beats talent. The real challenge isn't the market, it's you. The market is a mirror that reflects human emotion. When optimism reigns, prices rise. When fear spreads, they fall. And yet, through all those cycles, the long-term direction of enterprise remains upward. Businesses innovate, economies grow, and value compounds. The investors who benefit most are those who can ride through the emotional waves without being thrown off course. That requires patience, and patience comes from mindset. The average investor often underperforms the very funds they invest in, not because the funds fail, but because the investors can't stay put. They buy when excitement is high and sell when fear takes over. They move money in and out, chasing returns, always arriving late and leaving early. That's not a problem of intelligence, it's a problem of discipline. The lack of patience turns opportunity into loss. Your mindset must be built on acceptance. The acceptance that markets will fluctuate, sometimes violently, and that you cannot control those movements. You can only control your reaction to them. The successful investor doesn't panic when prices drop, nor does he boast when they rise. He understands that both are part of the same long-term process. He focuses not on glamour or prediction, but on endurance. Predictions make headlines, but patience makes wealth. Every year, countless experts will tell you where the market is heading, which sectors will boom, which ones will crash. The reality, no one knows. Not the television hosts, not the fund managers, not even the economists with the best models. The future is always uncertain. But the disciplined investor doesn't need certainty, only conviction. Conviction that human progress, over time, outpaces fear. Mindset also determines how you see risk. Most people see risk as the possibility of losing money tomorrow. The wise investor sees risk as the failure to stay invested for the long run. The real danger isn't the market falling 20% in a year. It's you selling during that fall and missing the recovery that follows. Every major downturn in history has been followed by recovery and growth. The only investors who truly lose are those who quit. Having the right mindset means finding peace with volatility, means viewing declines not as disasters, but as natural parts of the journey, even opportunities to buy more at better prices. It means ignoring the constant noise, the predictions, the panic, and focusing instead on what never changes: time, compounding, and human enterprise. Patience is not passive, it's powerful. It's what allows you to capture the rewards that impulsive investors leave behind. The markets will always test your nerves: sudden crashes, euphoric rallies, endless uncertainty. But through it all, your mindset decides whether you panic or persevere. And perhaps most importantly, mindset gives you freedom. Freedom from anxiety, from comparison, from the endless chase for something better. Once you stop trying to outguess the market, you start enjoying the journey. You invest not because you expect to outsmart everyone else, but because you understand that ownership of productive enterprise is the most reliable path to wealth. So if you want to be a successful investor, work less on your predictions and more on your patience. Strengthen your temperament, not your trading strategy. The market rewards those who can stay calm when others can't, who can hold when others fold, and who trust time over impulse. In the end, it's not the brilliance of your ideas that builds wealth, it's the steadiness of your mind. Now let me finish with this. On your journey, You will encounter headlines that promise magic, funds that promise exceptional returns, advisors that promise insider knowledge. My advice, treat them with caution. The only thing you can control is what you pay, how broad you are, how long you stay, and how disciplined you remain. Make those the variables you master. Ladies and gentlemen, you hold in your hands the greatest tool investors have ever had, the power of business ownership, time, and compounding. Use it, honor it, let it work for you. Don't let costs tear it down. Don't let speculation distract you. Stay the course.